Some years ago, I had a colleague who sent 3 kids through Princeton. My colleague also used to say that from a financial perspective, the experience was kind of like buying a new Cadillac every year and then driving it off a cliff.
Ben Bernanke joking at Princeton yesterday about the high cost of education. Now, I'm joined by Wonkblog's Dylan Matthews. We're going to talk about this growing student loan debt issue. And the second half of it, we'll kind of get into some of the proposed solutions. But first, let's get our hands around the scope of the problem with some handy Wonkblog-esque visuals. Now, we know housing debt is a big factor in the economy, but look at this. Student loans are now the second biggest category of debt in the U.S., more than car loans or even credit cards. And folks are having more and more trouble paying off these loans. As this next graphic shows, the red line of student loan delinquencies has been steadily rising, even as the other types of debt have trended the other way. People have generally been paying down debt since the financial crisis. And we'll get into this chicken or egg question in a minute, but first look at this. While almost every other age group, actually every other one, has had higher net worth than people did at the same age a generation before, not for Americans aged 29 to 37, who are actually poorer than folks that same age were back in 1983. Okay, take a deep breath, Dylan. There's a lot there. What do we make of all that?
So there's a lot to unpack in the last chart, because it's bringing a lot of things together. So not only is this the first generation to have a really significant student debt and student loan burden, but these are people who took out mortgages before the crash, and so might have had access to more credit and more mortgage debt than previous generations did. But there's no question that student loan debt is a big part of that picture.
So we know this is a big problem. In a way, it could be even a bigger problem for folks that are about to go to school, because their loan rates could double on July 1st. What is that, and what's the solution to that potentially?
Sure. So since the government has largely a monopoly on the student loan industry, it's so far been setting interest rates on these loans basically by congressional fiat. And the rate on subsidized Stafford loans, which are these loans specifically for low-income students, are set to double on July 1st.
3.4 to 6.8%.
Exactly. And neither Obama nor House Republicans want that to happen, but they both have different ideas for how to structure loans going forward, and they both want to sort of detach it from what Congress sets arbitrarily and assign it to something based on what markets are saying. The difference is that Obama wants to do it sort of like a fixed rate mortgage, where when you lend the money to students, they pay it back at that interest rate pegged to the Treasury rate. And that rate doesn't vary over the life of the loan.
So you take the loan out, you know what the rate is. The Republicans are saying you take the loan out, we'll see what happens with the interest rates, and it could vary some within certain thresholds.
It's a lot more like adjustable rate mortgages. It's a lot less predictable.
And so this whole fight is over student loans that would happen in the future, which is kind of different than what we're discussing before, people that are now saddled with these loans. So for people that already have these loans, what might help them? There's this thing about income-based repayment?
Right. So the gist is that you take a set percentage of your disposable income, so whatever money you have left over after housing and food and whatever, and you pay out that fixed percentage as your student loan payment every month for a period of time. And the main benefit for students through that is that if you do it for 20 years or 10 years if you're in a public service career, if you're a teacher or a police officer, they'll forgive the loan. And there's some controversy about what it's going to do, because on the one hand, it allows people to, it makes it less of a burden for a lot of families, but it also extends out how long people are paying stuff back to the government. And because of that, you're going to be paying a lot more interest. And so under some theories, the government's actually going to make money off of this. I don't know. It's a really new program, and it's really too early to say.
One of the big questions has always been whether these increasingly high tuitions and costs for schools are worth it, whether they're a good investment, and there's this scorecard that might help answer that question.
Yes, the Department of Education, in conjunction with the Consumer Financial Protection Bureau, are developing this thing called the college scorecard that gives you basic information about your college, like what the graduation rate is, or what the average salary is, like 2 or 3 or 5 years out. And getting this information is tough, and it doesn't tell you everything about a school. Many excellent art schools don't give a very high monetary return on investment, but may be a wonderful place to spend 4 years. But the idea is that
you just drive the Cadillac off the cliff.
Sure.
That could be its own art project, actually. Driving the Cadillac. Somewhere at RISD, there's a kid with a Cadillac.
There's a kid filming it, or not even filming it. It's an installation piece.
Okay. Dylan, good to see you, and something that I'm sure we'll be discussing more as this July 1 date looms.
Absolutely.